Hey, what's up, stock compounders? Brad here. So today I want to talk about rules for a shameless cloning portfolio. And I actually want your guys' help, okay? I want you to let me know in the comments, how would you design a shameless cloning portfolio? Because I don't have all the answers right now. I'm going to lay out some initial thoughts here, but this is really something that I'm going to be developing over time because I really do want to set this up. I want to set up a fund that just shamelessly clones a handful of great investors where all of the rules for buying and selling are kind of predetermined, so I can remove biases and emotion from the actual process of buying and selling. And the report that really inspired this whole thing, and Pabrai has referred to this several times in talks, it's really about how would you have done cloning Warren Buffett between 1976 and 2006? So for those 30 years, if you had simply bought when it was publicly disclosed that Buffett had bought, and then sold when it was publicly disclosed through 13F filings that Buffett had sold, how would you have done? So we can see in the abstract here, if you had followed this approach, you would have exceeded the S&P 500 index by 11%. Okay. Now the S&P 500 index over that period was generating around 12%. Okay. So you're talking about 21% compounded annual growth rate over those 30 years versus a 10% if you were just investing in the S&P. So incredible outperformance. Now, obviously, it's easy in hindsight to say, yeah, it would have been great to clone Warren Buffett. Really, what we're looking for is Warren Buffett in 1976, okay? Back when the portfolio was still relatively small. Back in 96, the equity portfolio for Berkshire Hathaway, public companies, was $125 million, okay? So, now it's what, half a trillion dollars, something like that. But there were a few insights that I pulled from this report on cloning Warren Buffett. So there's one right here in the abstract. We find that Berkshire Hathaway's portfolio is concentrated in relatively few stocks, with the top 5 holdings averaging 73% of portfolio value. Okay, so that is something I'm pretty interested in incorporating into a shameless cloning portfolio. Only looking at investment managers who have a very concentrated approach, where the top 5 holdings are, I'm thinking somewhere around 75% or more of the portfolio's value. This is average over those 30 years. Okay, so some years it was significantly higher than 73%. Some years it was lower. And then I just want to show one more. I want to show one more page in this report here. So this one here, right? So this shows the value, the Berkshire Hathaway equity portfolio by year, and it also shows the largest 5 holdings, what percentage those make up of the equity portfolio. You can see here, some years, look at this, 95%, okay, and there were 11 holdings that year. So you can see there's pretty dramatic swings in how many public companies Berkshire Hathaway owns in this period. You've got 110 in 1980, right? And then some years it's 11, I think, is the lowest that I'm seeing. So quite a range. You can see how it grew. The equity portfolio value, 125 million, like I said. Just 6 years later, it topped $1 billion. So that is very impressive growth in the late 70s, early 80s. You can see here, in the early to mid 80s, nowhere near that rate of growth. So anyway, just kind of interesting to look at. And you can also see what the S&P did in those years. So I want to take, kind of an introductory stab at, how I would design a shameless cloning portfolio. So there's a few things we need to ask ourselves here. First of all, who do we want to clone, right? Which portfolio managers, which investment managers do we want to copy for our shameless cloning portfolio? And what are the rules for deciding who to clone? Okay. So my initial thoughts on this: identify 5, okay, a handful of investment managers that are clone worthy. Now, what does it mean to be clone worthy? Well, I'd like to see at least a 15-year track record. Okay. And the reason that's important is, I want to see at least one, ideally 2 recessions in the mix. Because, if there's the Warren Buffett's expression, it's only when the tide goes out can you see who's been swimming naked. So if we're only looking at a period of time where the market has gone up, the portfolio isn't necessarily able to weather storms, right? It may not be able to weather a crash. So if we're cloning a portfolio manager, I want those companies to be able to weather a storm, right? I don't want the superior performance, the great performance of that investment manager to solely be a result of that manager taking more risk, right? I want to see, okay, is there any resilience in the approach for this portfolio manager? So if we take a 15-year history from 2021, we're going back to 2006. So we're including the global financial crisis in there. I'm still mixed about whether I would consider last March 2020, a recession. I think technically it was a recession. Stocks came down. I believe the S&P came down like 30% or something like that. But it bounced back incredibly fast. I don't know. To me, it's not a very robust data point in terms of a recession. But, I think 15-year track record, including the global financial crisis, is pretty reasonable. So that's that. Manage between 100 million and 1 billion. Now, why that range? So the 100 million, if you're not managing more than 100 million, you're not required to submit 13F filings to the SEC. Okay. Now, there's some managers I like who manage less than 100 million. And the way I find out what they're holding, take for example, this is Bonsai Partners. Okay, they're in California. Andrew Rosenblum. Micron is a fairly large, second largest position in that portfolio. But the only way I know what Bonsai Partners owns is because Andrew writes letters every quarter that are public, right? He makes these letters public. But if Andrew decided, okay, he's buying a position in something and, he's still buying by the time he's going to write the next quarterly letter, he may not disclose what he's buying. And so, if we're following managers under $100 million in assets under management, sure, maybe now they're telling us what they're holding, but there's no guarantee, right? There's no kind of robust system in place that we know we're going to have access to those buy and sell decisions within the portfolio. So that's why the lower end set at 100 million right here. And again, I'm not married to this. I could potentially be talked into lowering that. But the 13F filing thing, it just makes it certain that we're going to be able to see what these investors are buying and selling. Not totally certain. I mean, they can request, I don't remember what it's called, but Buffett did this a number of times where, he requested that he not disclose certain positions because he was still buying. and the SEC granted him kind of an extension in terms of having to disclose those particular positions. So it's not 100%, but for our purposes, I think it's good enough. And then 1 billion, the reason the 1 billion max kind of assets under management is when you get over a billion, so kind of general rule of thumb is that I'm looking for these investors to put about 10% of assets under management into a company, right? 10% bets on average. So if an investor is managing, say, $2 billion, and they want to make a 10% bet, they have to put 200 million into a company. Now, if you have these, I really want to be sub 500 million in terms of companies that I'm looking at. At least that's where Mohnish Pabrai seems to think there's more of a sweet spot when you get into the smaller range market cap under 500 million. So, if you're trying to buy a stock, right, with a 500 million market cap company, and you want to buy a $200 million position in that, you're going to own 40% of the shares outstanding, right? Now, it's going to be pretty difficult to buy 40% of the shares outstanding without moving the price significantly, okay? So, if you get too large, it's a lot harder, it's a lot more impractical to buy smaller companies. So that's why I have that 1 billion cap. I could even consider lowering that 1 billion cap to like 500 million. So having a range between 100 million and 500 million. Right now, Pabrai, I think, is around 500 million. So, this feels like a comfortable range at this point. Must have 75% of the portfolio in the top 5 ideas. So that's really just a rule of thumb that tells me, all right, these are concentrated investors. They like to bet big when a pitch comes, a fat pitch comes, right? That's kind of in their sweet spot. It's not the kind of fund that has hundreds of positions and the biggest one is like 5% of the portfolio. I'm looking for high conviction ideas, right? That's kind of what makes this work. So that's a metric that tells me, all right, this investor has high conviction ideas and it's showing up as kind of a substantial chunk of the portfolio. And again, I'm not married to this either. It just seems like a good rule of thumb, 75% in the top 5 ideas. Must have an 18% or greater compound annual growth rate since the fund started, okay? Now, 18%, there's no magic sauce here. 20% feels maybe too high, too restrictive. 15% feels maybe a little bit too low. And again, I don't even know if it's possible, how possible it is to figure out what the CAGR is for these fund managers, particularly in the days when they've been managing less than $100 million, right? So say you have a manager who's managing, 200 million, okay? Maybe they've only been managing over 100 million for the last couple of years, right? They've been able to double the fund size in the last couple of years, but I'm not sure how possible it is to see, what this growth rate, what this rate of return was previous to that. If you guys have any tips on, I think Guru Focus may allow us to look at track record of different managers. Now that's a paid service, but curious to hear from you guys if you have any tips on how to find investment performance or calculate that. Other than just manually looking through 13F filings and estimating that way. So that's who to clone, right? Which fund managers to clone. And if you guys have any suggestions for who might fit this kind of, these metrics, I don't think Pabrai, I don't know that he actually does. I don't think he's had an 18% plus performance over the last, since I think 99 is when he launched his fund. So 22 years. I don't think he's had this. But again, I mean, he's my investment mentor. I planning on including him in here. But anyway, just my initial take there. Now, so that tells us kind of, maybe gives us guidelines about what to buy based on which managers we're following here. We still need to know, at what thresholds are we buying? Does it need to be 10% of the portfolio? And when are we buying? Are we buying right after the 13F filing comes out in the middle of, say it's for December 31st, right? The Q4 13F filing. Are we going to be buying right on February 15th or February 16th, kind of the day after the 13F is released? Are we waiting until the end of the month to buy? Which is what, in this imitation of Buffett portfolio, that's what they did. They bought at the end of the month, when the same month that the 13F filing was released. And the reason for that, you can get a pop in these Buffett buys, right? Everyone sees Buffett bought, ooh, there's a increase in popularity for the stock, the price jumps, and then maybe it comes down a little bit by the end of the month, because investors with their emotions can tend to overshoot when things like that, when events happen, like you see, oh, Buffett just bought this company. So when exactly do you buy? And what is the threshold? Does it need to be 10% of the equity portfolio or 10% of total assets under management? Those can be radically different numbers depending on which investor you're looking at. I think Pabrai, yeah, anyway. And then when do you sell? Okay, same thing. Do you sell right when the 13F comes out? Do you wait until the end of the month? What is the threshold for selling? Does it need to be, all right, the investor sold 50% or more of the shares that they owned? Or is it, if they sell any, do they need to completely liquidate the position? So these rules are really going to matter in terms of, they're important. It's important to predefine all of this stuff. Say you decide, all right, I'm going to sell when half of the shares get sold. Well, what if the investor sells 20% of the shares, right? And then another 20%, and then another 20%. Do you have to track, what the peak was, and how difficult is that going to be to track? So those are some things to consider in terms of selling. And of course, how many stocks do we want to own, right? I think 10 is a good number. But then with those 10, how quickly do we want to get into those 10? Do we want to say, all right, each quarter we're only going to buy one, right? Or, you might think, well, if there's a crash, right? If there's a crash and I can only buy one, is that going to be very limiting? Don't I want to buy more than one if there's a crash and all these other guru investors are loading up and it's quite clear that they're all loading up? And I don't necessarily want to have that limitation. But I also don't necessarily want to buy into all 10 stocks in the first quarter, right? If there's 10 companies that fit the criteria that I've set, right? And I've set the criteria, I've got 10 things. It's like, well, now I have to do that, right? So what limits do I set? And what limits are reasonable in terms of how many stocks to own, how quickly they should be allowed to be incorporated into the portfolio. And then, if I buy 10 and I haven't sold any, right? Because none of the investors that own those 10 are selling. Am I stuck? What do I do? What do I do? How do I buy more, right? So it's a tricky thing here. It needs to, the rules need to be set up to allow it to be dynamic, but at the same time, as much as possible, removing my ability to make emotional decisions at the wrong times. So it's quite a complex challenge setting up a shameless cloning portfolio. And then I've just got a few notes down here that I think most of them I've already covered. Yeah, 10% total equity, 10% assets under management. What about foreign stocks, right? If we look at Pabrai, he owns 2 companies in the U.S. which show up on the 13F filings, right? And those happen to be his 2 largest positions. If you go into ticker terminal, you can see that. But actually, let's just hop in there rather than just talking about it. Let's show it. Okay, hopefully I'm already logged in here. So let's go to Track Investing Gurus. Pabrai, okay. So we can see here, right, these 2 are U.S. companies, the first 2, Micron and Seritage. And reported value of shares held. Now this is, who knows when this is probably the price as of December 31st, 2020, times however many shares are held. So this is the estimated value of those holdings. So you can see here, South Korean company, Indian company, Turkish company, Shinnikin, Japanese company, another Indian company. So how do we deal with foreign holdings? Do we want to include foreign holdings? And if we include foreign holdings, we're going to have different reporting standards, right? 13F filings, that's just U.S. holdings. So we have to rely on these trade reports or shareholder reports. Japan has its own kind of SEC equivalent, Edinet. Do we want to track that? So that's a big question. What about foreign companies? A lot of those markets that Pabrai owns, I don't know how to buy in. I can buy Japan through Interactive Brokers, but I don't know how to access South Korea or India or Turkey. So, I think my initial take on that, just companies that I can buy through U.S. exchanges. Okay, it just simplifies that whole thing. But it also, it's compelling during markets, times of the market like what we're in now in the U.S. to be able to buy some foreign positions. So, and who knows how long the froth could keep up in the U.S. If it keeps up for another 3 to 4 years, I may be kicking myself for having that limitation of only being able to buy U.S. companies. Or whatever happens to the U.S. dollar, right? That could also work against a cloning portfolio that only allows domestic holdings. So anyway, guys, that's a lot I just threw at you. It's a lot I'm trying to wrap my head around. Obviously, simplicity is going to be a very important thing here. So just throwing everything against the wall in this initial video, but I do want to make it really as simple as possible without making it too simple, making it overly simple, where I'm kind of leaving performance or sacrificing performance, I should say. So it's got to be in that kind of balance, those two things. Simple, but effective. Effective at cloning the performance, right, of these great investors. that we're going to be cloning. So if you have any suggestions about who to clone, or if you don't like kind of what initial criteria I've set here, let me know. Give me your case for why those should be different. Let me know who I should clone, who I should look at for cloning. If you have any tips for how to calculate performance of these guru investors. There's a lot here, guys, but let's have a conversation in the comments. Let's flesh this out, and hopefully I can really kind of hone in on a strategy that has some well-informed guidelines, some well-informed rules about how to operate this portfolio. So with that, guys, thanks for watching, and I'll see you all in the next video. Take care.